Hello everyone, this is Mr. Darius, and today's business pill is about measuring the size of a business. Now there are certain things that I see that usually people do when they measure businesses that I believe to be totally wrong as a business consultant, and I'm aiming to help you within this video understand how it's better to actually measure the size of a business. The vast majority of people that I meet have this common error in mind when they're thinking of measuring the size or the potential of a business, and they look at profit. And we're going to start with that because that's problem number one. So this is something I would totally recommend to avoid when you are looking at measuring a business. So profit. Why not profit? And I'm going to give you an example, but first of all, I would like to explain what profit is. And don't worry, we will have another lesson about profit in which we explain all the types of profits that a business can encounter and how much eventually from initially what we had as a gross profit is actually going to be the profit that we will be able to enjoy after we have paid everything. So profit is the money that your business has left after it has paid all its costs. And here we can think of costs with salaries, with taxes, with utilities, with bank rates, machinery, leasing, so on and so forth. And eventually what it has left is profit. And say, well, people say, wow, that company is an extremely solid, and it's got to be a big company, and it's got to be a performing company because it has had profit. Now I want to give you the following example. So Coca-Cola, let's take for example Coca-Cola, okay? Now Coca-Cola did not have any profit, let's say, for this year because they decided to reinvest in 10 other countries and build another 10 factories, and for that reason they have encountered a loss. So Coca-Cola doesn't have profit this year. On the other side, if we go at the small corner shop over there or at the small bakery that is within our neighborhood, we will come to realize that by the end of the year they have encountered a profit of $10,000. So the common mistake we can make over here is say, wow, the bakery is much more performant and might be better than Coca-Cola. Okay, so when you compare two businesses, you definitely shouldn't do them by profit. Okay, there's no term of comparison between Coca-Cola and that bakery. So first of all, I would not recommend to compare businesses through profit. And second of all, I would recommend that when you compare businesses, do it, or make sure you do it, of businesses which are at least in the same industry and are pretty close in terms of comparison. And we're going to discuss that further. But I'm going to come back a bit of profit, and usually profit might not be encountered in a lot of companies. Profit could also be something that appears on paper, especially in accountability, just because of window dressing. So profit could be the result of window dressing. What does this mean? This means that we publish our company's account and we handle them in such a way that we put our company's financial image in a more favorable way, although the reality is not the same. And when it comes to profit, there's another problem that we need to keep in mind. If our profit is of high quality or low quality. High quality profit is a profit that is sustainable and you can repeat it. So it's a profit that will look like this. Okay? So it's very easy for you to repeat your performance if we were to look in a graph. On the other side, low quality profit is a profit that is not easy to achieve, but is almost impossible to repeat it. And I'm going to show you with the example of the graph. So here is your first year, here's your second year, here's your third year, and then you see you have no chance. So this is year 1, year 2, and year 3. So you have no chance of repeating that profit whatsoever. So this being said, this is my personal opinion on why we should not compare companies through profit. Make sure that you underline and understand the fact that some companies would rather reinvest money before they actually reach to the calculus of profit, just because they think it is more feasible to pump money in the business to expand the business instead of just recording profit. Okay, so then going back to the ways we actually measure the business, now I've now explained why I don't agree with the profit and I don't recommend it, is going to compare businesses, first of all, by number of employees. So number of employees, and this is an important one. When we look at a company that has 1,000 or 10,000 employees, we can actually gain an idea about that company. But again, when we look at the size of the employees, it's really important to understand if we're comparing companies that are both capital intensive or both labor intensive. And I will explain this concept so that you understand that it's not actually fair to measure a company that is capital intensive and to measure a company that is oriented towards producing in a labor-intensive way. So first of all, here you have to ask if you're capital intensive or if you're labor intensive. Oh, sorry. Capital intensive means that the vast majority of the production process is made by machinery, by technology, and we have people that assist it, but those people or those employees are actually very highly skilled and very well paid and are very few in number. On the other side, we have labor intensive, and this is very specific to countries in which the labor force is very accessible and it's abundant, and it's the situation in which the vast majority of the production process is made through human labor. So then again, if this company has 1,000 employees and this one has 10 employees, it would be fair to say that this company is bigger, okay? You might say that. But in terms of revenue, performance, what it actually does and how many clients it serves, the capital intensive one will be maybe with thousands and thousands of performances over the labor intensive. So be very careful when you compare by number of employees, which I said that it is an indicator of how we look at the size of a company. Make sure that besides, as I've mentioned, both being in the same industry, they're both either capital intensive or either labor intensive. So the second one would be revenue, which is selling price multiplied with quantity sold. Okay, so revenue of a company over a year kind of gives us an idea of what level is that company actually, what size or at what scale or in what league is that company actually playing, okay? Now the third one would be capital employed. And by capital employed, you should understand capital invested. You cannot compare the small corner shop that has invested 10 grand to start and operate, and its return rate and its way of operating and its way of being as a business in size with a huge multinational that invested hundreds of millions and produces a return rate and has a number of employees and plays in a totally different league. So capital employed, meaning the money that is invested initially to start that business, is also a very good indicator to let us know in what league that business is playing and what kind of size we are dealing with. The next one would be market share. So what do I mean by market share? You should think about it this way. How much from the total sales within an industry were actually done by your company. And we could think of market share as a formula, and it's very easy to calculate. So it would be the, let's think of it this way. The total sales that our business has encountered, so the total of sales of our business, and I would say here Audi, okay, divided by the total sales in the car industry. Multiply by 100 because it's a percentage, okay? So this will actually let us know how much from the total sales in the car industry were sales that were recorded by Audi, and then we can realize what is Audi's share on that market. Now, the larger the share, the larger your possibilities to actually increase your business. The larger the share, we will actually understand that we are dealing with a company of a different size that plays in a different league. Now, we have to be careful because in some countries, the government tends to intervene whenever we jump over the 25% market share threshold, because they want to avoid monopolies. They want to avoid that situation, better said, in which one player controls the entire market and there's no longer fair competition and fair chances for others to play on that market. Now, this being said, I'm going to the last way of measuring the size of a business. And I have to say that the reason why we have this star over here is because it's applicable to companies that are only listed on the stock market, and it has to be around the concept of market capitalization. So again, we have market And why do I say that only PLCs? So this is valid only for PLCs. We have a previous lesson in which we discussed the concept of PLCs. What does it involve? So PLCs listed on the stock market because it involves shares. So you cannot calculate your market capitalization potential if you do not know the number of shares okay, that were issued multiplied with the value or price of a share. Okay, so we can look at the company that is listed on the stock market and realize that it has 1,000 shares and each share has $10, and we can understand that in terms of market capitalization, it can raise by selling its shares 10 multiplied with 10,000, so that's $100,000 or euros or pounds. Okay, so that is the size of that company, and we can compare with other companies, but only the ones that are also listed on the stock market. So this being said, I truly believe that these 5 steps are the healthiest steps that you could use in measuring the size of a business. Now, very important when we discuss about number of employees to understand if that business is capital intensive or labor intensive. When we discuss about revenue, to actually look on the performance of the company on a longer term. So maybe look at the revenue over a year, okay? So just because one month one company had a higher revenue than another company doesn't necessarily make it bigger in size, okay, or better. Number 3 would be capital employed, and here it would be very obvious that the level of money that was invested, or the sum of money that was invested in that business, will actually bring you to a certain level because you need to spend money in order to make money. Number 4 would be market share. So here you have to look how much from the total pie does your company has in terms of slices. And last but not least, but this is applicable only to companies listed on the stock market, is market capitalization. Be very careful, avoid measuring businesses in terms of profit. This is Mr. Darius. Thank you for watching this video. If you have any queries, don't forget to write me an email and I'll help you. Thank you.